Ashwini Agarwal of Ashmore joins us right now. It's been a while, Ashwini. So good having you. Thanks so much for taking the time out. Neeraj here. Good morning. What's your sense? How are you approaching the market right now? We are in a state of flux, but the markets have had a bit of a pullback move. Would you consider this as a bounce which will get sold into?
Neeraj, it's very difficult to predict what's happening in the short run because one is that there are several moving parts. There is the COVID-19 data not only in India but all over the world. There is a huge amount of fiscal stimulus which is causing expectations to change pretty much on a daily basis based on what macro data comes out from which country. The Indian market is taking big cues from what's happening overseas for its day-to-day movements. So honestly, day-to-day movements are extremely hard to predict. What I can say is that this shutdown or lockdown, while it's necessary from a health and public order perspective, will create a significant pain for the economy. Frankly, the street, for example, has seen public notifications by one retailer and one consumer products company over the long weekend. But I think we should expect more of this kind of news to come. Whether this rally gets sold into or not, I can't say. But I think the economic situation is fairly serious at this point.
Ashwini, good morning. We've seen a whole host of quarter four updates that have come in, and now we're stepping into the quarter four earnings season, which is going to be another bummer. Do you feel that people should largely take quarter four out of the equation when you're trying to look at making investment decisions, because that's a variable that you cannot pinpoint right now to say when things will start changing thereon, and therefore it is a known variable, but wait it out. Sit on cash. That's the philosophy right now. Cash is king.
So a little bit of both of the options that you outlined are true. Typically in the sell-off, long-term investing reaps great rewards. But short-term, if you wish to time your trades better, you could hold on to some cash. So, there is part truth in both statements. If you go back and look at history of the sell-offs, the markets don't give you clear signals till you're well past the bottom, right? So whether we are behind, whether the bottom is behind us, or whether we still have more downside, or we will test the same bottom that we saw on 23rd or 24th of March once again, we will know only in hindsight. I think what is also true is that the market, if you consider a medium term, will not worry too much about the March quarter earnings or even the June quarter earnings, provided a particular company that you might be looking at hasn't become broken as a result of the financial stress it has gone through. So the simple thing is that the liability side of the balance sheets for all companies is going to come under stress. If that stress is manageable, the street will be willing to look through the pain for the March quarter and the June quarter. If the stress is unmanageable, then I think whether the stock rises or falls, and in this environment, it might still be advisable to exit. So it is very stock specific, and sitting on cash as well as investing, both of these things make sense. You have to do it gradually and pick your bets very carefully, because we are stepping through a minefield as we speak.
All right. Ashwini, a lot has been spoken about pharma being the next bright spot in this entire turmoil. Do you feel that pharma, while is a good pocket to hide in a period of uncertainty, is not a comparable investment when things start to become better? So you will still have returns coming back into the high beta names, and therefore at that time pharma will see money being made, money being pulled out and put into better high beta names.
So it depends on a whole bunch of factors. first, we have been reasonably positive on pharma for a long time, for almost a year now. And our whole argument was that the sector has seen a significant derating since 2015, while the regulatory goalposts had become a lot stricter and a lot harder to achieve. Most companies have adapted to the new demands being made by international regulators, and going ahead, we see fewer long-term disruptions to operations for pharma companies. The domestic franchises were more than justifying the stock prices, and you were paying virtually nothing for the international business. So, that in a summary, in a short summary, was how we were looking at pharma. I think that story continues to be on track. Of course, as people have tried to move money between sectors in this mayhem, pharma has been the beneficiary, and which is why the stock prices have significantly rallied. But to my mind, I think this sector has more legs to go. What I do worry about, of course, is that it has become more or less a consensus trade. And consensus trades, work over the short period of time. Over a medium term or a longer term, I don't know how this one will play out. We'll have to wait and see. The other question that you put forward is that will high beta names that have sold off significantly see a comeback whenever risk comes back? The answer is, of course, yes. While the conventional wisdom says that market leadership changes at each turn of the market, I think what is also true is that a lot of financials which have seen deep cuts, down whatever 80% from the peak or down 70% from the peak, they will stage ferocious rallies, whenever the risk appetite returns. And at that point in time, if you're significantly overweight pharma for those few weeks or months, maybe, pharma will not do as well. So, all that will happen. I think the key question for investors out there and for investors like us is that what do you see as the sustainable value of a business or the franchise once this entire crisis is behind us? Is the balance sheet a balance sheet that is going to survive, or will it need significant recapitalization? As an equity owner in the business, will you get significantly diluted, or will you continue to maintain your share of the ownership of the business? And what is the value, therefore, that is inherent to the business or intrinsic to the stock? And compared to that, what are you paying? So, these are the questions that need to be answered. And I think, yes, there is value in many of these beaten down names, which will do well whenever the risk returns.
So Ashwini, how do you kind of choose between them? Would you look at, because the future is so impossible to predict right now, would you look at, say, the last 10, 15 years and see which of these business models have survived cycles and bumps in a better fashion? Is that a way of narrowing down on names?
So that is certainly one way. The other way is simply to look at who has access to capital, who doesn't. A third way to look at is what is the inherent leverage on the liability side of the balance sheet, and on the asset side, how much is the pain that's going to come through. So one has to make estimates about these things. All of this is very hard to do because the environment is extremely uncertain at this point. We don't know when the lockdown lifts, whether it's 30th April, 15th May, 30th May. We have absolutely no idea. We don't know when workers will return to factories. We don't know what restrictions will be placed on transportation once the lockdown lifts. We don't know what kind of capacity utilizations most businesses will be able to operate with. So, all this is up in the air. So, some of the commentators in the past weeks have said that the virus is going to decide the outcome of the market, not us, and not values. And in some sense, that's right. So it is very, very uncertain time. And while we can make some guesstimates looking at the past data, looking at the balance sheet, looking at the liabilities as well as the asset side, I think everyone has to be aware, including ourselves, that whatever choices we make are fraught with risk, and things could turn a lot uglier or a lot better compared to the base assumptions we make.
Then Ashwini, I have a question, and this is from a perspective of people who might have been lucky enough to sit on maybe 5, 10, 15% of cash, or whose portfolios are also aided by a steady stream of maybe salary income or business income, even though it might be in a bit of a limbo right now, but business income that is coming in on a monthly or a quarterly basis. Should people be in a hurry to deploy that cash because valuations are arguably a bit more attractive than what they were at 12,000, or it makes sense to maybe sit on the sidelines and wait for the event and the dust to settle down? Even if you're buying it 10% more expensive, you're still gaining on the probable time value.
Neeraj, I'll give a slightly nuanced answer to this question.
Sure.
I'm a huge believer of asset allocation. Okay, and asset allocation is individual specific. It is based on your risk appetite, it is based on your age, it is based on your income, it is based on your liabilities and the financial surplus that you have after meeting your monthly expenses or weekly expenses or whatever it is. And I would say that people should turn to their asset allocation, think hard about what their equity exposure needs to be. And if they were adequately exposed to equities, my guess is that this sell-off, they are now underweight equities compared to where they should be. And a gradual realignment of that weight would be in order. However, if you are unfortunately in a situation that you owned more equities compared to what you need to, then I don't think you should venture out anymore and put any of your spare cash to work. I think everyone should take a time to reflect on what their equity exposure needs to be. And if you're below that number and you're lucky enough to be below that number, this is a great time to be invest. Put the money back into the market in slices. I would say, divide it on a weekly basis or fortnightly basis over the next 4 or 5 months, and I think that will do you extremely that will do extremely well in the medium term. So, for example, if your equity exposure should be, let's say, 50% and you're at 40%, invest 1.5% each month, or 0.25% each week, something like that. That will get you to your investment goal. That will prevent you from panicking whether the market goes down or goes up in the short run, because if it goes up, you at least bought something, and if it goes down, you still have more ammunition to go into the market with. I mean, that's what I would advise.
Ashwini, I want to ask you, are you looking at any niche businesses? I mean, just smaller businesses. So within healthcare as a pack, maybe diagnostics, maybe specialty chemicals, all of these smaller pockets, because they offer value as well. So would you feel that just, digressing a little bit from mainstream companies, looking at some of these mid-cap niche businesses could, be fruitful when the tide turns?
Absolutely, Devina. We spend a lot of time studying mid caps and small caps. As you well know, that small caps have fallen significantly since their previous peak in January 2018. It's been, almost 2.5 years since then. The indices are down 50% from their peak, and if you look at individual stocks, in some cases they're down 70%, 80%. So there is a lot of value out there, and not all balance sheets are broken, not all businesses are broken. In particular, the space you spoke about, specialty chemicals or pharmaceuticals or niche pharmaceuticals, yes, there is a lot of excitement around those stocks. They have actually done quite well, even in the sell-off. But I'm not suggesting that they're still not good businesses, and many of these balance sheets are very robust. De-risking away from China for global buyers, the opportunity to build scale in India because of our chemistry and our manufacturing prowess. These are all facts. I mean, these are not myths or pies in the sky. So will some of these businesses do extremely well over the next 10 years? Are we at, in some sense, where IT companies were in early 2000? Possibly. So who will be able to scale up? Who will be able to, get the clients, get the manufacturing, comply with the global ask on environment, on ESG? These are the tougher questions these companies will have to address. But I think there is a great opportunity out there in the specific space that you mentioned.